Hello everyone, Happy Sex Petroleum and TWL Holdings. Let's start. Basic formulae mean plate holding MBHD established DEC 21st, 1994, renamed July 16, 2010 paid up capital 35.2 million Malaysia ringgit. Business core real estate concrete plant for supply chain cost cutting, expand healthcare wholesale restart, investment building material trading loans. Founded 2007, Malaysia listed firm, listed on Bursa Malaysia Main Board July 25, 2011, HQ, Kuala Lumpur as of October 3, 2025, stock price 1.57 Malaysia ringgit, market cap about 114.3 million Malaysia ringgit, 400 staff, Sharia compliant short selling allowed. Focus on oil and gas exploration, development, production, technical service, global assets, Malaysia, UK, Australia, and Brunei. Okay.
Number two, standalone risk analysis. 2.1 standalone risk analysis and voluntary. The first one, definition of standalone risk. Assess the independent risk level of individual stock without considering relationships with other stock or incorporating diversification factors. The second one, voluntary data. Hibiscus stock voluntarily is 0.086293841. TWL is 0.165340836. Standard devaluation of monthly returns. Third one, voluntary analysis. TWL is voluntary is nearly twice that of heavier risk, with more unstable returns, significantly influenced by market statement and inequality constraints. Last one, industry characters. Inspect being effort by oil price influences. Behaviors exhibit more moderate voluntary demonstrating the relative stability of the energy industry. 2.2 CAPM model and expect return. Beta values. The first one, beta values. Beta equal 1.723. Beta TWL among negative 1.136. CAPM formula is E RI equal RF big letter F plus beta RM minus RF big letter M, where RF equal 3.59% RM or big letter R 9.19%. Expect returns. Calculate expected return for risk among 13.24%, TWL among negative 2.777%. Implication of beta. Heavy risk, high beta indicate high market sensitivity and higher expected returns. TWL as negative beta shows counter cycle behavior rare in the Malaysia stock market. The last one, market implications, TWLS, slightly negative CAPM expected return indicates the market does not reward such risk, such risk, affecting structural or inequality issue. Number 3, portfolio risk analysis. Risk factors. For a portfolio risk dependent on individual stock, voluntary and inter-stock correlation monthly data shows Hiberius volatility at 0.0863, TWL at 0.1653 with low and slightly negative correlation. Second one, diversification benefits. Hiberius oil and gas and TWL real estate belong to unrated interest with weak return correlation allowing the portfolio to reduce risk and generate significant diversification benefits. The last one, negative beta impact. TWLS negative beta characters negative 1.136, further reduce market exposure, enhance risk handling in fact beyond basic diversification strategic.
Okay, next one is optimal weights of each stock. Optimization method. Standard mean variance optimization is used to determine the optimal risk portfolio, with Hibiscus having an expected return of 13.24%, risk of 0.0863, and low negative correlation with TWL. Weight allocation. Due to high volatility, negative returns, and price instability, TWL has a small or negative weight in the optimal portfolio. Hibiscus dominates with a positive weight over 19%, while TWL is mainly used for hygiene. The next point, beta coefficient of selected stocks. The first is TWL data. Data value of approximately minus 1.136 show rare counter-cyclical characteristic negatively correlated with Mars trends, but no stable defensive asset with limited hygiene effect. The next point, Hibiscus data is Hibiscus data. Beta value of 1.723 indicates high Mars sensitivity, reflecting the cyclical nature of the oil and gas industry, 1% March inflation leads to approximately 1.72% stock fluctuation.
All right, I'm moving on to chapter 6. So SMA is based on the CAPM model. The CAPM formula we used is the expected return equals risk-free rate plus beta market risk premium minus risk-free rate. Beta we computed from our monthly return regression. Hibiscus beta
我不知道你什么时候换页啊？
我会出 next 的呀。
那从头再说。
All right, I'm now moving on to chapter 6. So the SML is based on the CAPM model. The CAPM formula we used is expected return equals to risk-free rate plus beta multiply the market premium minus risk-free rate. The beta we computed from the return regression. We plugged these numbers into the CAPM formula to get the expected returns, and then plotted the SML using beta on the x-axis and the expected return on the y-axis, where our two stocks fall relative to the SML. About the hibiscus, expected return from CAPM equals to 13.24%. Actual performance is above the predicted value. So on the paragraph, hibiscus sits above the SML, meaning the stock delivers a higher return than what is its level of risks would normally justify. This basically indicates the stock is undervalued or attractive. About the TWO, CAPM gives a negative expected return, minus 2.77%. Actual performance is far below this level. TWL sits far more below the SML, showing that the market is not rewarding its risk at all. Next. This is the Excel formula shows that hibiscus trend, EPS, and PE. We use the information we get from the annual report of the two companies. EPS dropped during the oil market downturn 2019 to 2020, but rebounded strongly in 2021. Indicates cyclical earning behavior tied to oil prices, but positive long-term recovery. PE rises in periods of falling EPS, reflecting market expectations of future improvement. As earnings improved in 2021, PE normalized. EPS and PE show declining performance and inconsistent profitability. TWL's financial metrics reflect a distressed or speculative stock rather than a value-generating firm. Next.
Part 8 Conclusion Risk and Return Profile Volatility Comparison TWL's volatility is significantly higher than hibiscus, with poor return stability more affected by market sentiment and liquidity constraints. Hibiscus demonstrates relative stability of the energy industry despite oil price fluctuations. CAPM expected return. Hibiscus expected return of 13.24% reflects high market sensitivity and return potential. TWS negative 2.77% shows counter-cyclical characteristic but negative expected return. Portfolio and fundamentals. Diversification effects. The low correlation portfolio of the two stocks reduce overall risk, but TWI contributes negative to portfolio returns. Optimal allocation has hibiscus with over 90% weight. TWR used only for limited hedging. Financial indicators. Hibiscus EPS shows a recovery trend, rebounding to 0.1518 in 2021, with the PE ratio rising to 19.49. TWL continued to incur losses, with financial indicators reflecting distress and speculative attributes. Investment implications, industry dynamics. Amid cyclical fluctuation in the energy industry, hibiscus maintains relatively stable volatility and positive expected returns. TWL in real estate is more affected by policy and market liquidity, with mismatched risk and return. Strategy allocation. Rational investors should optimize hibiscus for stable returns. TWL should only be used as hedging tools in special market conditions with strictly controlled positions. Last one, final thoughts. Hibiscus investment merit. Strong fundamentals, expected returns of 13.24%. Moderate risk level, EPS and PE ratio gradually improving with industry recovery, suitable for long-term value investment. TWL assignment, high volatility, negative expected returns, and design financial indicators indicate high-risk characteristics, provides diversification benefits, but unsuitable for long-term value investors, recommended only for short-term tactical hedging. Optimal portfolio strategy. Core allocation to hibiscus for primary returns, minimum TWL allocation to hedge market risks, maximizing risk-adjusted returns. That's all. Thank you.